If you're a trustee for a family trust here in the UK, you've probably heard of a form that can cause a whole world of confusion, Form IHT100B. Get it wrong, and the penalties can be pretty steep. That's why today we're going to walk through some practical guidance put together by the tax experts at My Tax Accountant, one of the UK's most trusted accounting firms. Our goal? To help you navigate this whole thing with confidence. So let's get you the answers you need.
So, picture this. A family trust, set up years ago, now needs to be changed. But what are the rules? What does HMRC need to know? It's one of those situations that's just filled with uncertainty and, honestly, potential tax pitfalls if you're not careful. This is exactly the kind of problem we're going to clear up today.
Okay, let's make this real. Meet David and his sister. They're trustees for a trust that was set up for their mother. She's now decided she doesn't need the income from it anymore, so they've all agreed to end her interest and pass the assets on. Now, on the surface, that sounds straightforward, right? But that one action actually triggers a specific reporting requirement to HMRC, and now they're left wondering, what on earth do we do next?
To get them and you an answer, here's our plan for today. We'll kick things off by decoding exactly what Form IHT100B is. Then we'll get into the big question, do you actually need to file one? After that, we'll take a quick tour of the key sections, look at those all-important deadlines and penalties, and finally, we'll talk about getting the right expert help.
Right, let's get to the heart of it. Before you can even begin to think about if you need to file, you have to be absolutely crystal clear on what this form is for. Seriously, understanding its specific job is the first and most crucial step to getting this right. Now, before we go any further, there's a key legal term we need to get our heads around: interest in possession. Look, in simple terms, it's just the right a person has to the income from trust assets. Think of it like the interest from a savings account, or maybe the rent from a property that's held in the trust. The beneficiary gets the income, but not the actual asset itself. Simple as that.
So, here's the crucial point. Form IHT100B is the specific form you use to tell HMRC when that interest in possession comes to an end, and here's the key part, while the beneficiary is still alive. That is its one and only job, and that during their lifetime bit is absolutely essential to remember.
And this right here illustrates the most common point of confusion. Honestly, this is what catches so many people out. If the beneficiary's interest ends because they've passed away, you do not use this form. That event is reported by trustees on a different form, IHT100B death, or by the executors on form IHT418. The form we're talking about today is strictly for lifetime events. Okay, so you know what the form is for. But now for the million-dollar question. Do you actually need to fill one out? This is probably the most critical decision you'll have to make as a trustee. Let's break it down.
So here's a quick way to think it through. First, was it a lifetime event? We've covered that one. If yes, you move on. Second, where did the assets actually go? Now, even if they were transferred directly to the beneficiary, don't just assume you're in the clear. And third, and this is where it gets tricky, does the event qualify as what HMRC calls an accepted termination? This is where it often gets complicated.
Now, this is really interesting because it gives us a peek into HMRC's thinking. This quote from Jack Harper on the Trust Discussion Forum is spot on. You see, you might do the maths and figure out that no inheritance tax is actually due, but that doesn't mean you're off the hook. HMRC uses these forms to keep tabs on assets and ensure compliance. They have, as he says, a policing role.
And here's my tip for you. It's a really common assumption that if you just give the assets back to the person who was getting the income, you don't need to tell HMRC. But that's not always true. The rules around what counts as an accepted termination are really complex. They depend on values and previous transfers. It is always safer to check than to assume. Right, let's say you figured out you do need to file. What does the form actually ask for? We're going to take a quick tour through the most important sections so you know exactly what's coming. You'll definitely want to hear this part. The form's broken down into a few key sections, and each one asks for specific details about the trust itself, the person who set it up, the beneficiary, and of course the assets. Section F is the big one. This is where you list all the assets that are part of this transfer, and you have to be comprehensive. We're talking everything from property and bank accounts to stocks and shares, and even valuable personal items like jewelry or cars if they're held by the trust. It's basically a complete financial snapshot of the event. And here's a little something you need to know. The valuation isn't just a rough guess. HMRC requires the open market value for every single asset, and it has to be the value on the exact date the beneficiary's interest ended. Getting this wrong can cause some major headaches down the line.
And that's not all. The main form is really just the beginning. Depending on what the trust actually holds, you'll need to fill out several extra schedules. There are specific pages for shares, for property, and for claiming important reliefs like agricultural or business relief. It just goes to show the level of detail that HMRC really expects.
Now, stay with me. This next part is crucial for every single trustee. Knowing what you have to do is one thing, but doing it on time is something else entirely. The deadlines are strict, and the penalties for getting it wrong can be, well, pretty significant.
Okay, let's break down these deadlines, because they depend on when the event happened. If the interest ended between the 6th of April and the 30th of September, any tax is due by the 30th of April the next year. But if it happened between the 1st of October and the 5th of April, you've only got 6 months from the end of the month it occurred. It's so easy to get caught out by that difference.
If you miss that filing deadline, you're hit with an immediate, automatic penalty of £100. And listen carefully to this part. It doesn't matter if there's no tax to pay. The penalty is for the late submission of the form itself. That one detail trips up so many people.
And it doesn't stop there. If the form is more than 6 months late, HMRC adds another penalty, currently £200. So that brings the total up to £300, just for missing deadlines.
But this is where it gets really serious. For delays of more than 12 months, the penalty can shoot up to a maximum of £3,000. And those are not the kind of numbers any trustee wants to be explaining to their beneficiaries. It just really highlights why getting this done on time is so important.
So, we've covered what the form is, who needs to file it, and the pretty serious consequences of getting it wrong. Let's pull all of that together and talk about the clear, practical next steps you should take. Let's just quickly recap the absolute must-know points. First, remember, IHT100B is exclusively for lifetime events. Second, you might have to file it even when there's no tax to pay because of that policing rule. Third, watch those deadlines. The penalties really do escalate quickly. And finally, getting that open market valuation right isn't optional, it's a requirement.
Now, it's really important for me to say that this has all been for general guidance. The world of trust tax is incredibly complex, and the rules can and do change. So please, don't rely on this as a substitute for tailored professional advice about your specific situation.
If you're like David and his sister, and you find yourself needing to deal with a trust, the very best next step is to speak to an expert. To get through this with complete confidence and make sure everything's handled correctly, you can contact the specialist at My Tax Accountant. Just give them a call on 0208-570-8531, or you can email them at info@mytaxaccountant.co.uk.
Well, I really hope this has helped clear up what Form IHT100B is all about. For more practical guidance on all things tax, please do subscribe to the My Tax Accountant YouTube channel. Thanks for joining us.